Emma.
Thanks, Emma.
All right. Good morning, everyone, and welcome to Congressman Joe Courtney's remote distance roundtable on the need to finally allow for student loan borrowers to refinance their loans in the same way that so many other Americans can refinance other debt. We've got a great panel this morning, and it looks like we have several members of the press on with us already. Our call is only scheduled to last for 45 minutes today, so I'll keep myself brief while I introduce our panelists. Joining us from the Student Borrower Protection Center is Mike Pierce, their Policy Director and Managing Counsel. We're also happy to be joined by Colleen Keller, a UConn student and a representative of the Connecticut Public Interest Research Group, Adam DeWitowitz, a Wyndham resident and a student loan borrower who has been impacted by this himself, and Rachael Johnston, owner and broker at Johnston & Associates Real Estate. Thank you all for joining us today, and thanks to all of our other guests who are able to tune in. Remember, after Congressman Courtney and the panelists give their brief opening statements, we'll open it up to any questions that you all have. And if you do have a question, just make sure to click the raise hand button towards the bottom of your screen when it's time. One other thing to flag for folks is that we are recording this event today. And if you'd like a link to the video once we conclude, just let me know. With that, I'll hand it off to Congressman Courtney.
Great. Well, thank you, Patrick, and thank you to all the panelists that have joined us this morning, and to the media again, all kind of adjusting to the new reality with Zoom meetings. The sort of instigation of this event was the introduction of legislation last week in the House of Representatives, HR 7449, which is the Bank on Students Coronavirus Emergency Loan Refinancing Act. Also has a companion bill in the U.S. Senate with a couple dozen co-sponsors in the Senate, again introduced by our neighbor from Massachusetts, Senator Warren. And in a nutshell, what this bill does is that on July 1st, just a few days ago, the U.S. Department of Education issued their new terms for student loans, Stafford loans, for the next academic year. And again, the formula that's used for calculating that interest rate is basically, it uses as a benchmark the 10-year Treasury note yield rate, which, as many of you know, is at a historic low. It's at 0.7%. In an escalator of 2 points. So the new rate for this coming academic year for students who, again, take out loans to pay for tuition and other college-related expenses is 2.75%. Historically, looking at Stafford undergraduate loans, that is about as low as it's ever been in history. And so obviously there's been some slight benefit for students in terms of the low interest rate environment because of Federal Reserve policy that, again, is allowing student loan interest rates for next academic year to be, again, at a much more affordable rate in the past. And we're seeing that obviously through other forms of consumer debt, whether it's home mortgage interest rates, which 30-year mortgages now at roughly 3%, 15-year for even less, and credit cards and car loans, et cetera. The legislation, though, is dealing with a problem that exists that's very unique to college student loans, which is that legacy debt. In other words, loans that were taken out last year or going back years before cannot be refinanced unless Congress actually passes a law that creates that legal pathway. And what our bill does is it basically allows people with undergraduate student loan debt to have the opportunity to get that lower rate of 2.75%. For those who are holding direct student loans, which again are loans that have been issued by the Department of Education for about the last 10 years or so, our bill would require the Department of Education to automatically refinance the interest rate to that lower number. For people who, again, for some categories who have student loan debt from that are not direct student loans, and some of those were issued years and years ago, the FFEL loans, the Ford loans, you would have to apply. But nonetheless, everyone would be entitled to the 2.7% who has an undergraduate federal student loan. And we would also open that opportunity up to people with private student loans to apply to get that lower rate of 2.75%. Again, the way the formula works for Stafford loans, graduate student loans have a slightly higher rate than 2.75%, and the same is true of Parent Plus. In all those categories, though, the rate that was issued on July 1st is far lower than what legacy debt is required and still by law people are paying. Again, I'm going to just finish by sort of giving a quick snapshot in terms of just what's been going on since the coronavirus hit. Under the CARES Act, again, Congress created sort of an automatic forbearance so that people were excused from paying principal and interest on student loans up until September 30th. I'm pretty sure I got that date right. I almost have to refresh my memory until September 30th. So there actually has been a bit of a respite for people that, again, the CARES Act provided for. But once that expires, the existing rates that people are paying is just going to snap back into place. And people are going to be confronted with the reality of having to deal with the monthly payments. And again, the legacy rates are pegged at interest rates that are far higher than almost any other consumer debt that's in the economy right now. The HEROES Act, which is still pending in the Senate, proposed extending that forbearance period out, but we have no idea what the Senate's going to do with that. And so, from a simple fairness standpoint, and also from the standpoint of trying to, again, put more money in people's pockets at a very fragile moment in our economy, this refinancing bill, I believe, and I know I've got a number of colleagues who jumped on the bill as co-sponsors, makes perfect sense in terms of trying to provide, I just think common sense relief that is a matter of course in terms of refinancing that people do in other forms of debt which they're holding right now. Middle-class families, refinancing is American as apple pie. This issue has ramifications outside of just the existing debt that people are holding, and we'll hear from Rachael Johnston, who will talk about that in terms of high student loan debt and the impact it has in terms of qualifying for buying a home and getting a mortgage. And we're also joined by Mike Pierce, who's as I mentioned earlier, is the policy director and managing counsel of the Student Borrower Protection Center, who can talk about, again, just this predicament that people are in who are student borrowers, and also just the ripple effect it has in terms of other abilities to move ahead in life financially. So Mike, thank you for joining us, and I'll yield the floor, as they say in Washington, to you.
Mike, you may have to unmute yourself. We had a little feedback, so I muted everybody.
Thank you so much, Congressman, for the introduction. Is that working okay, everybody?
It says, yep.
Okay. Thank you so much for the introduction, and thank you for your leadership on these issues. This has been a challenge for now 2 generations of Americans who are struggling under the weight of more than $1.7 trillion worth of student debt. And in our current moment, struggling with record unemployment and a global pandemic, the student debt crisis has taken a different turn and has really created a barrier to opportunity for the people that are economically distressed, those that have fallen behind on their student loans, but also for everybody else. And our research, I do want to use just a minute of my time today to talk about a paper that the Student Borrower Protection Center put out last month that talks about the secret price of student debt. So what our research found, looking at consumer credit reports for people across the country, co-authored with the Credit Builders Alliance, was that borrowers have a burden from student debt, but they also have this additional secret price that they pay when they go to access all other kinds of credit. So a borrower that has student loans, particularly a borrower that has a high student loan burden, a high debt to income ratio, will pay more over a lifetime when they go to take out a mortgage, or when they go to finance a car, or in particular when they go to use a credit card. And one of the things that we're seeing right now in the middle of this once in a century economic crisis is that borrowers are struggling for money, and that money has to come from somewhere. And often the money that they use to be able to put food on the table is financed with a credit card. And student loans mean that borrowers pay more for credit card debt. And so what we're seeing here is the secret price is becoming a bigger problem for families today than it was even 6 months ago. And Congressman Courtney and Senator Warren's legislation takes the important step of bringing down the burden of student loans on student loan borrowers' finances. And that's true whether you've fallen behind on your student loan payment, whether you've got a payment that's been paused due to the CARES Act, or whether you have a loan that isn't covered by the CARES Act, like the millions of people with older federal loans or private student loans. And so I'm thrilled to be able to be here to talk about our research, but more importantly, to talk about how important this bill is to unlock the economic potential of a generation of student loan borrowers. So thank you again for the chance to join you today.
Great. Thank you, Mike. And thank you for your research. Again, this is, just an issue that we've got to approach it from every angle. And the secret price, as you point out, is something that I think, frankly, a lot of members of Congress are not aware of. So that's really good work. Our next speaker is Colleen Keller, who's from the Connecticut Public Interest Research Group, which is a student organization on the UConn campus. Thank you, Colleen, for joining us. And again, from a student perspective, and obviously from your organization's perspective, we really welcome your input.
Yeah, thank you for having me. So hi, everybody. I'm Colleen. I'm a rising junior at UConn, and I'm the chapter chair of UConn PIRG. College affordability, from loans to open source textbooks, has been a priority of our organization since its founding in 1973. And we are so excited that Senator Warren and Representative Courtney are introducing this legislation. Potential college debt is very intimidating for high school students who are about to make one of the biggest decisions of their lives, and it's often really debilitating for recent graduates. The fear of this debt can affect career choices and impact how much money graduates can put into the economy. And now, given the realities of this pandemic we've got going on, I know friends that are scared to death about their futures in higher education. But this bill uses common sense to reduce the severity of this problem. We need to make pursuing an education an exciting and an invigorating thing so that more of our young people can maximize their talents and make a difference. And saddling them with student loan debt is not in the public interest. By allowing eligible borrowers to refinance their federal loans or to refinance their private loans into the federal program, college will become much more accessible. I'm looking forward to seeing all of the amazing things that my generation will be able to do should this bill become law. So we look forward to working with Senator Warren and Congressman Courtney and all of the other advocates in support of this effort. Thanks for having me.
Great, thank you. Great job, Colleen. So as is mentioned before, the total debt level, as Mike mentioned, is 1.7 trillion. I think it's important to note that the group that owes the most student loan debt right now, according to the Federal Reserve, is between the ages of 35 and 49. That's 14 million borrowers between that age group there, and it's the total, that group owes a total of 575 billion. So again, it obviously is an issue for students who were enrolled today and who took out loans as freshmen or sophomores or juniors, but obviously there's a legacy debt issue. And I really thank Adam DeWitowitz, who's a construction manager professional, lives in Windham, Connecticut, for joining us today to sort of give us some perspective from that part of the student loan issue. Thank you, Adam.
Thank you, Congressman, and thank you for having me here today as part of this roundtable discussion. As a 39-year-old father, I can say that I graduated with my undergraduate degrees in 2003. And I graduated with my graduate degree in 2010. And in that period, and even up until now, it's been interesting to watch how college affordability and student loans have changed over time. And very much to Mike's point of the hidden cost, for a long time after I graduated with just my undergraduate degree, I actually struggled even then to find a job that would allow me to balance my needs of life with my ability to repay my student loans. And so in a lot of time period there, deferment with capitalized interest at those higher interest rates was my only avenue. Fast forward toward the 2007-2008 timeframe, I had started pursuing my master's with the idea that having an advanced degree would give me greater opportunity, understanding that I would have to take on more student loan debt at those higher rates still. And in my position, what I think is not unique to me is that around that 2008-2009 time period, I was actually laid off like a lot of people were due to the mortgage crisis. And because of that, because I was laid off for near 2 years, I essentially, while looking for work to get back to be able to pay for things like my student loans, I lost income, 2 years worth of income in my lifetime of working that I'm never going to be able to recover. And so I was able to, complete my degrees, and it has now taken me essentially 17 years to be able to get to the point where I'm now a working professional with an income level that allows me to repay my student loan debt at the longest time period possible in order to have the lowest monthly rate possible, or monthly payment possible, to be able to balance the needs of being able to have a home, be able to put food on my table, all of the monthly things that we pay for, feed my children. And that's with a working spouse. And those high interest rates just continue to capitalize on top of, the initial principal, to the extent that you almost can't see, when I'm making my payments every month now, I can't see the balance reducing. And that's a weight that I carry. I mean, at 39, 40 years old, I'm looking at just over 20 years to retirement. And my plan is extended based on 20 years. So at best, I'm looking at, if my loans are repaid in 20 years, I'm going to look at repaying them just about the time that I'm getting ready to retire. And that's one of those other hidden costs that's in there as well. In doing this, I've had to defer large chunks of income that other Americans without this debt, or grew up in a generation younger than me that paid for college completely when it was less costly, and loans, quite frankly, weren't as available as they are today. They're saving for retirement. They're saving 10, 15% up to the federal maximum levels in their 401k programs. I cannot do that. I'm in the 5, 6, maybe 8% category. A lot of people can't do it at all. So there's a trade-off that is also hidden there, that people are putting their money into their student loans, understanding that it was a betterment for them, but at the same time, they're deferring things like their retirement, their 401. And at 20 years out, coming into retirement, that's a scary thought, to be looking at the end of your working period, or having to extend your working period and not having a lot of savings in the bank for retirement.
Great. Well, thank you for stepping forward and just, again, sharing the real world. And obviously, getting the kind of these rates written down would shorten that payoff period, and obviously allow you to sort of move on to other priorities, which, are fast approaching. So lastly, we have Rachael Johnston, who again is head of the Eastern Connecticut area of realtors, and again, as somebody who's out there in our economy every single day and working with middle-class families and working families in terms of trying to buy homes, and has a very, I think, accurate and deep view of the impact of student loan debt, and the benefit that having refinancing as an option could provide to her clients. Thank you, Rachael, for joining us.
Well, thank you, Congressman, and thank you certainly to your staff as well for inviting me to be part of this. Student loans certainly have an impact on the real estate market. Our National Association of Realtors conducted a study and released it in 2019, which was a profile of buyers. And in that study, it was revealed that 39% of first-time home buyers have student loan debt. On top of that, they were asked, what are your top expenses for delaying, saving for either down payment or a full home purchase? And overwhelmingly, student loan debt was the #1 deterrent for being able to secure the down payment money that they need. That was above credit card debt and car loans and healthcare and all other expenses. So in many cases, those saddled with high monthly payments have either reduced or no buying power. In our office alone, we've seen numerous young professionals come through who've landed great jobs and are ready to make that first big investment of their home, and their mortgage gets denied because of their debt and the high interest rates that they're paying on their debt. So people may say that right now the real estate market is moving, it's hot, and you would be correct in saying that. It is a seller's market. Inventory is extremely low. Properties are moving quickly, and some of them with multiple offers. However, with the low buying power that they have, those candidates or those potential buyers with high student loan debt, they're losing out on the opportunities. They're just not able to secure these homes. We all know real estate's a cyclical market. It's going to change. I think as all of these sellers are going to jump on the bandwagon and put their houses on the market because things are moving right now, it's going to change. It's going to change from a seller's market back to a buyer's market. We know that that happens. But these young professionals with the high student debt are going to have difficulty in that market as well. And they're going to be left with no option but to rent. And what renting does, there's sort of a ripple effect, is when you rent, you don't do home improvements. So you don't support the local hardware stores, you don't support the local furniture stores, you don't support, even the big box stores like the Lowe's and the Home Depot. So bottom line is this bill is so critical for our market as well. To be able to have a lot more young professionals be able to get their first home would be a wonderful thing. So thank you for asking me to be a part of this and to represent realtors across the state.
Great. Well, as I said, this issue, and Adam and Colleen, did a great job. It really is just all pervasive. And when you're talking about 1.7 trillion, that's a huge overhang and a drag on the economy. So thank you all for joining us. Again, we ran some numbers. If a borrower, let's say, has $50,000 in debt and is carrying 6.8% interest, which is not a uncommon scenario, with 7 years left on their term, the savings is about $8,000 in their pocket, which that's real money, obviously, and you can play with a calculator, endlessly in terms of running the different scenarios and the different numbers. And as I said, that we're not discharging principal balance. That's obviously another sort of priority that other groups are pushing out there, and that's a discussion that people can have. But refinancing, as we've heard, is just something that is a natural sort of anti-recession sort of phenomenon that happens, and it is happening right now with people who have home mortgages, and to have the low interest rate environment that we're in and having student borrowers just completely shut out in terms of being able to take advantage of that just makes no sense from a policy standpoint. We're doing everything we can to make the case to our colleagues in Washington, and I want to thank all the guests here today because you're going to help us with real world input about the fact that this is a really smart move for the country to take. So I don't know, Patrick, if you want to open it up to any questions that our friends from the media might have.
Absolutely. I think, and Emma, if you could help me out as the host, the official host here. I think we have Len Bestoff on from NBC. Folks, well, excuse me, rather, if you have any questions, please just click the raise your hand button and we'll bring you on. It's at the bottom right hand of your screen. If we don't have any questions, we might not have any questions. Oh, we do have a question.
Len, you just can unmute yourself.
Okay. Hey there. Thanks, everybody, and thank you for holding this, Congressman. So I know the numbers you just said were like a typical person, 50,000 in debt, over 7 years left, might save you about $8,000. So that's roughly $1,000 a year for the typical person paying back one of these loans?
That's correct. And again, that's, it obviously translates into lower monthly payments, like any other refinance on a house or condominium or whatever. And again, the nice thing about this bill, which is, there's been different versions of this sort of swirling around, but the provision that would just have the Department of Education just do it automatically for people holding direct loans. I mean, I think that really is just a really important feature. Having the pause in payments under the CARES Act again, the Department of Education had to do that across the board automatically, and it's been very successful. So, that's not sort of mission impossible from a logistics standpoint.
In terms of, if this is allowed for everyone, this loan forgiveness, not just the folks originating these Pell Grant loans, is this something where wealthier borrowers are sort of going to get away with something here because they were probably able to pay at these higher rates?
So, that it is true. I mean, this is a universal proposal, and but I would just say that I don't think anyone really in setting up interest rates saw this as kind of a means-tested kind of issue. I mean, the bottom line is that we're not excusing principal balance. And so in terms of, that sort of moral hazard, kind of argument, this really doesn't, in my opinion, violate that. And it really just simply says that there really is no excuse for when the entire economy and its Federal Reserve policy to reduce people's out-of-pocket in terms of borrowing, whether it's the government or whether it's businesses or whether it's homeowners, that really it should be extended to this other cohort of Americans.
If I may ask one other question too.
Sure.
Thank you, Congressman. What about former borrowers who just maybe already paid back these loans at these higher rates? Are they going to somehow get some kind of repayment, or there just has to be a strict cutoff here?
Yeah, I think it's for existing loan debt. I mean, I'm sympathetic, because they obviously, played by the rules and were diligent in terms of doing that. But frankly, that's true of a refinanced, home mortgage, that somebody didn't get the opportunity to, take advantage of.
Thank you, Congressman.
Yeah, great. Good to see you, Len.
Thank you. And folks, it looks like we still have a few other members of the press on with us. If anybody else has any questions, just click the raise your hand button on the bottom right there. And if we have no more questions, give it a few more seconds. Folks, if we have no more questions, I think that concludes it. Congressman, do you have any final words before
Just real quick, we have additional materials if people have, follow-up questions. And I just want to thank all of our guests. I mean, you obviously did such a great job and explained everything so well that, I think we and I believe that actually, it's very nicely done, and look forward to staying in touch and working on this issue in the future.
Thanks, everyone.
All right.
Thank
Take
you,
care.
Congressman.
Stay safe.
Bye, everyone.
Thank you.